oil was not the trigger for the crash, unlike in 1990 or 1980, where they were the trigger for the crash. If we go back here to the Iranian Revolution, we can see oil prices spike big time, huge correction in markets that lasted a couple of years. Okay? So, look, the key point I want you to take away here is that if oil prices come down very quickly, if the conflict resolves itself relatively quickly and oil gets back under $100 a barrel, probably not the worst situations are going to play out. If oil price disruptions remain and price goes above $100 a barrel significantly, say to 150, then the likelihood of a stock market crash becomes highly elevated in that scenario. We might even have a Zweig breadth thrust coming up. Banana posted this. So the Zweig breadth thrust is halfway there. I hope, here's an updated chart. As a reminder, it needs to get to that 0.6 at the bottom of the chart, which is the upper threshold within 20 days or 2.5 days there. So if that plays out, which of course then will require some kind of a resolution, maybe the escorts through the strait will be enough, then in that scenario, markets will probably bounce back. And these sort of previous crises may not be the best indicators. Because again, a lot of the crises that we've had have already had stock market situations happening, interest rate hikes, credit default swaps, all this other stuff happening in the background. Oil was not the trigger for the crash, unlike in 1990 or 1980, where they were the trigger for the crash, okay? Context is important.